Hello and welcome to this week's episode of Double Line Minutes. I'm Jeff Mayberry with Sam Lau.
Hey, hey.
It's just after 10 a.m. here Pacific time on October 11th. We have a weird holiday on Monday where the stock market is open, but the bond market and banks are closed. So just remember that when you're trying to decipher what happens on Monday.
Yeah, and for those of you who are driving on commuting on Monday, it should be hopefully a pretty light commute. Gotta love
Oh,
those at least the bank holidays, right?
yeah, but except we had to go into work.
Nope.
Well, with that, Sam, why don't we get on to the where are we for the week? It was a quiet week, but some movement there in the financial markets.
Yeah, I mean, pretty quiet week as you said, but today does launch the earnings season as well. I'm looking at looks like most of the major banks started off the earnings season with some reporting out there as early as this morning, and then wrapping up through tonight as well. But financials, as I look at it on the day, are the best performing sector, up about 1.8% thus far on the day. That brings it into a positive handle for the week to date at about 1.7%. But I'm jumping ahead a bit. S&P 500 up about a point on the week to date basis. Year to date up over 23% right now. Technology is the best performer, up over 2%. As I mentioned, financials up over 1%. In that cohort, you got healthcare and industrials also up over 1% as we speak right now in this early recording. Materials also positive, up 75 basis points right now. So those are the five sectors that are in the green for the week to date basis. Consumer staples just right there on the cusp at -1 basis point. The other five are in the red, led down by utilities, down 2.8%. The rest are down about 50 basis points or so on the week to date thus far. Moving over to fixed income, yields are higher across the board with the 2-year note right now at 3.93, just 1 basis point higher over the close previous Friday. But when we go farther out in tenor, looking at the 10-year note, that's at a yield right now of 4.07%, 10 basis points higher in yield versus last Friday. Moving down to the bonds at a yield of 4.38%. That's 13 basis points over the previous close. So across those three tenors, at least two of those three, the 10-year note and the 30-year bond, are all higher, have a higher yield today than they started out the year with. Only the 2-year note is lower, and that's 32 basis points lower than where we started. So that's kind of indicative of where we are in terms of the monetary policy, in terms of heights rate cycle right now, indicative as we've seen the steepening of the yield curve as it's back no longer inverted, as we talked about a few episodes ago. So what that meant for the broader bond market, when we take a look at the U.S. Bloomberg U.S. bond aggregate, that's down about 40 basis points on the week to date thus far. Not liking that move up in yields at the longer end of the curve, but that still remains in the positive territory for the year to date, up over 3% year to date. With the move in yields, the only sector that really benefited thus far this week to date is the bank loan sector. That's up about a quarter point week to date. Everything else, for the most part, in the red. High yield is slightly in the red. We'll see. It could pull off a positive week, or at least kind of a flattish week. But right now, it's just hanging out about down about 5 basis points. The more duration sensitive sectors of the market are definitely in the red here. We see IG corporate credit and U.S. Treasuries down just around 40 to 50 basis points between the two of them there. Going over to the commodity side of things, commodities as a broad complex measured by the Bloomberg Commodity Index is down over 1% week to date. That's managing to hang on to a positive print for the year-to-date basis, up 6.5%. But taking a look at WTI crude oil, we've talked about this for the last few episodes of Double Line Minutes here, but given the heightened geopolitical risk, we've seen WTI crude oil futures move higher. This week is a little bit of the same there. It's up about 1.3%. Right now, I see it as a dollar price of $75.36 for the front month futures contract of WTI crude oil. On the year-to-date basis, that's up over 5. Gold just kind of flattish on the week, right now. It's up just under 50 basis points, a dollar price of $2,658 right now, as of October 11th. It was kind of funny. I was digging through some old stuff yesterday. Jeff and I pulled out this receipt of some actual physical gold that I bought for my uncle back in 2017. And at that point, the purchase price was $1,310 a troy ounce. So it's a good job, Uncle. He more than doubled in that over the last 7 years. But yeah, I'm sure the definitely crossed the bid-ask spread on that, and then someone that's
Yep.
buying that physical gold. Not to mention the inconvenience factor of going down to the jewelry district down here in LA. But with that wrap up of the markets, Jeff, do you want to kick us off on what happened on the macro front?
Yeah, Sam, it was the inconvenience factor for you, convenience factor for him.
Correct. He just waved it in.
That's right. All right. It was a pretty quiet week. On Wednesday, we did get the FOMC meeting minutes. Nothing really to look out for there. There was, we were talking, I think we were going to lunch and we are talking about how the meeting minutes basically said there was a lot of conversation about whether they want to do 25 or 50 basis points. And that makes sense given that there was a dissent there on the voting side. Thursday, we did get the CPI. This was inflation week, so we got CPI on Thursday and PPI this morning. CPI came in at 0.2% month over month, was estimated to be 0.1, so a little bit higher than that. The core CPI, so ex food and energy, came in at 0.3, was expected to be 0.2, so again, slightly higher there. That brought the year over year core CPI to 3.3 and the year over year headline CPI to 2.4. Not really much going on though. Market didn't react too much to that. It was, as I said, a little bit higher than consensus estimates, but nothing really stood out in terms of what kind of the drivers there. It was really a ho hum reading. Uh, Shelter and owner's equivalent rent inflation cooled down slightly to 0.2 and 0.3% month over month, respectively, and kind of it didn't really, I guess, core services excluding shelter. That's kind of the one thing that the Fed had been talking about. That climbed a little bit to 0.4% last month, but it's kind of flat year over year. So you didn't really get too much of a move there from markets, and in terms of kind of the market moving effects of the CPI, really nothing going on. Market has seemed to start to discount the CPI numbers a little bit there. We also got the jobless claims numbers. We're always keeping an eye on those. They came out on Thursday also. The initial jobless claims came in at 258,000. That was 28,000 higher than estimates. And continuing claims came in at 1.861 million, 31,000 higher than estimates. Now, the rationale behind this increase of why those numbers were higher is mostly due to Hurricane Helene. And if you kind of broke it down by state, a lot of those states that were affected most directly by the hurricane had elevated levels. So we'll have to see whether I would say we can see whether that would be something that kind of falls off in the next couple of weeks. But certainly we got Hurricane Milton here. Was it 2 days ago or 2 nights ago? So those numbers will look to be even more elevated, I would think, for the next 2 or 3 weeks. So it may take a little bit more time there to see whether that's going to how those hurricanes are going to affect things. Also saw some news reporting out or some Wall Street research out saying that last time we had pretty large hurricanes, it actually had negative non-farm payroll numbers. It'll be interesting to see. Again, we don't get that until the first week in November, but whether these hurricanes have a material negative impact upon the non-farm payroll numbers. So again, grain of salt. We'll have to see how that shakes out, but something to think about when we do get that payroll number in a couple of weeks. Again, like I said this morning, we did get the PPI. PPI final demand came in flat, so it was a little bit better than expected. It was expected to be 0.1. The ex-food and energy came in at 0.2, right in line with the expectations. And that brought year-over-year PPI final demand to 1.8 and ex-food and energy to 2.8. Now, we don't really, obviously PPI matters, but really what we want to look at is now that we have PPI and CPI, how does that fold into what the PCE number is? That's the Fed's preferred inflation gauge. What does that number, or what do those components flow into PCE? We have something from UBS economists that said that they once we have the PPI, CPI, headline PCE should be about up 1.5% in September. Core PCE 0.23%. So that would bring the 12-month core PCE to 2.6, between 2.6 and 2.7, they say. And that headline PCE will go down to 2.1%. So they say very nearly the Fed's 2% inflation target, but they're not targeting headline PCE, they're targeting core. So that's still at 2.6. So coming down, but and heading towards that 2% level, but not really there yet. So I'd expect that the Fed, and even though the markets have started discounting inflation, I think that's going to sit in the back of the Fed's mind, and maybe rate cuts won't be as aggressive as the market is contemplating. And finally, this morning we did get also the University of Michigan 5 to 10 year inflation expectations. They came in at 3%, right in line with estimation, and so really nothing to do there. Also, from the inflation expectation side of things. If we do look at the interest rate probabilities, what's the market pricing in with that payroll number last week? No inflation bounce here. We're at an 88% of a Fed rate cut in November 7th. Remember, that's it's on a Thursday, so 2 days after the election, because they didn't want to have a meeting during the election. And then we have a 90% chance of another cut in December. So really, we're looking at two cuts for the end of the year, and kind of looking outwards from here. We have like an 80% chance of a cut in January, 97% in March. So the market's really pricing in or slow down their rate cuts. We're in 25 basis points for the next 5 meetings or so, or 4 meetings, and then we got a 50-50 in that fifth meeting, and it slows down from there. So it'll be interesting to see kind of how the markets have tended to overreact, brought a lot of volatility when we get the CPI, the inflation numbers, the jobs numbers. So it'll be interesting to see how the market kind of reacts to these prints that we're getting, and whether the economy is slowing down and the Fed has to be more aggressive on their rate cuts.
Yeah, certainly the market seems to have been coming in more in line with what the Fed had projected through their summary of economic projections report in September, at least to the median number there. So seeing the kind of 100 basis points of total cuts in 2024, it's coming back in.
Yeah, and I watched the Channel 11 video this morning that was just released, and Ken has a pretty good chart there, just showing the dots where the market was on September 30th, where the market was. I think he recorded it on Tuesday, where the market was on Tuesday, and it's a pretty dramatic move, given it's been eight calendar days from the end of the month, and to see that kind of huge shift in the expectations of Fed rate cuts.
Yeah, that's right.
Also, since it is inflation week, a couple of things we like to look at every once in a while is the Atlanta Fed. Their sticky CPI is at 4%. Their flexible CPI is actually at negative 2.1. So that's obviously how the CPI numbers coming in lower. The Cleveland Fed has their median CPI. That's 4.1% year over year. Their trimmed mean CPI is at 3.2. All these numbers are elevated compared to where the Fed would want to be. But those numbers are coming down. They're coming down very slowly, but they are coming down. So the Fed can feel comfortable that with time, as long as we continue on the same path, the inflation will get back down to 2%.
Yeah, so those are a couple of things that I don't have the actual episode numbers down right now, but you and I had gone through all the various measures of inflation and the ways that the various Federal Reserve banks calculate it. So it's always interesting to see their competing methodology, but overall to see what the output is.
It was I have it up. It's episode 19 from June 11th of 2021. So it was a
Wow.
long time ago.
It feels like that time has just really flown by, but
Yeah.
here we are on episode, what is it?
What,
170,
86?
186. All right. All right. So quite a few that we've put
Yep.
under our belt now here, Jeff. So nice work on that. But in terms of the things to keep an eye on, for next week on Wednesday, we continue this kind of inflation week from that we had this week into next week, as you longer term listeners of the minutes episodes are aware of. We like the inflation data that we get from the import and export prices price indices that we get because those are unadjusted indices. There's no hedonic adjustments in there. It's just the straight prices for the import and exports for our country here. But in terms of what we're seeing next week on Wednesday, we have import price index on a month-over-month basis is expected to be flat at negative 0.3%. On the export basis, the export price index on the month-over-month basis is supposed to improve slightly, but still be still be negative at negative 0.6% on the month-over-month basis. And there's no early indicators of the import price and export price indices on a year-over-year basis, but as of the last reporting, the import price index for year-over-year was positive 0.8. Exports was negative 0.7%. So we'll see how those change on the year-over-year basis. Now on Thursday, we have retail sales that come out, and on the so-called headline component there, it's estimated to increase from 0.1% in August to the current or the next release of September, improving to 0.3%. When you strip out auto and gas, that's expected to be at 0.3%, also a slight tick up from the prior month. And then similar type theme when we look at the control group, which the control group is also ex autos and gas. But if I recall correctly, they removed some other categories like building materials or construction inputs from that control group. But the reason why that's important is because the retail sales control group is the input that goes into the personal consumption expenditures basket that's used in GDP.
That's right.
And it's not to say that when GDP in that calculation, they don't look at the auto, they don't look at the gas and gas stations or construction building materials. It's just that in the GDP calculation, they feel that they have better prints than just using this survey. So instead, they go to industry groups and look for numbers that they collect from that data source. And then, of course, on Thursday, we generally have the initial jobless claims data as well as the continuing claims data. So we'll continue to see if there's any trend shifts there. But right now, it seems to be, for the most part, in line for the initial jobless claims with 240,000 expected for the October 17th print. And that pretty much wraps up the things to keep up on next week. Seems like a pretty light week there, Jeff.
Yeah, Sam, I was gonna say you're starting to think like Thanksgiving time already, so we're not gonna get it on that Thursday. So
that's right.
This is not always. There's always a dangerous word there.
It is.
All right. With that, I think that wraps it up for this week.
Yeah, I want to thank everyone for listening to us out there on DoubleLine Minutes. Don't forget to hit us up on the X at DLine Minutes or send us an email to the more traditional way at minutes@doubleline.com. I don't think we've ever received a letter via the USPS yet, but that'll be interesting if we ever get something like that. But you can go ahead and address that to DoubleLine Minutes, care of Jeff Mayberry, Sam Lau, Eric Dahl, and Mike Kimbrough if you want to go about that way and use one of your forever stamps.
I guess that's the one way to do it. Jason, our social media guy, just told me that the chart I talked about on channel 11, he's going to repost to our Minutes account there at DLine Minutes, Sam, as you said. Don't forget our YouTube channel is youtube.com/DoubleLineCapital. We do have the most recent Channel 11 episode out. I watched it this morning. It's titled A Second Chance for Yield Allocations, as we do have that increase in yields recently. And so if you missed the early one, now's your second chance at it. Early next week, we should have Jeff Sherman's asset allocation webcast up. That's titled As the Cycle Turns. We have the new Between the Lines blog post up on the LinkedIn. And with that, I'd like to thank everyone for tuning in and hope everyone has a great weekend.
Yeah, thanks everyone, and good luck out there.